rough patch, the Indian economy is slowly coming back to life. Let's take a look at the economic indicators. After clocking a sub 5% growth for 2 consecutive years, the first time in the last 25 years, the economy in the current fiscal is expected to grow between 5.4% and 5.9%. The benchmark S&P BSE Sensex has gone up 21.4% since the beginning of 2014. And GDP growth is expected to rise to about 6.5% in 2015 and at least 7% in 2016. Finally, there's been a promise of a stable government. The encouraging economic data has significantly minimized the risk of macroeconomic instability. The Indian rupee is showing greater signs of stability, and the current account deficit in the last fiscal came down to 1.7% of the GDP, compared with 4.7% of the GDP in the previous year. The index industrial production, after being flat for about 2 years, registered a growth of 4.7% in May, and is now expected to remain in the positive for the rest of the year. Inflation, which has been one of the biggest concerns in recent times, has also shown early signs of softening. Inflation-based consumer price index for June came in at 7.31% compared with 8.28% in the previous month. Inflation based on the wholesale price index for June was 5.4%. The business cycle indicator has shown growth of 6.6% in June. And how does this affect the stock market? These improving economic indicators should help boost investor sentiments in the marketplace, which would then help in manufacturing growth. Sensex is expected to continue to outperform Asia ex-Japan and global indexes in the quarters ahead. And over the next 5 years, the market is expected to provide around 15% compounded annual growth rate, driven initially by multiple expansion and then by earnings growth as economic growth picks up.